folks, we're diving down into my top 3 favorite REITs of all time. These offer me tons of different sectors and global diversification. We're talking about Stag Industrial, RioCan, and Medical Properties Trust for those juicy dividends, that passive income that you can utilize today. These REITs have been more or less acting like growth stocks, and I'm going to try and explain to you why. But for those of you that are new to the channel that aren't really familiar with REITs, these are the second largest proponent of my 300K portfolio, showing you the diversification mix. 31% of my sector allocations sit in information and technology, followed by the second largest weighting being these real estate investment trusts. So consider hitting that like button, and let's dive right into this by first of all talking about my favorite REIT, being Stag Industrial. This is an industrial REIT that deals with warehousing, currently paying a 3.3% dividend yield, a whopping PE at 38, and almost a $7 billion valuation. If we just take a quick look at the assets minus liabilities, and I know this is boring, but this is kind of how I get the value of the underlying assets, because they have 4.8 billion in assets and a total liability here of about 2 billion. So they're saying about 2.8 billion in underlying value that they could literally rip apart today and end up with cash in their hands, which is quite a ways away from the almost $7 billion market cap. So there is a hefty premium attached to this company. But let's dive down into this, because they are primarily leveraged into e-commerce, and that has been their focus moving forward. And they've actually been scaling up a lot with Amazon. Amazon used to make up 3% of the portfolio. Now it's at almost 4%, but we can see they have exposure to FedEx, like absolutely incredible company diversification mix. I've always wanted to shake the management's hand for how incredible this mix of tenants truly is. And we can see that 40% of these tenants are handled in e-commerce activity, and they kind of show you the retail inventory of sales kind of slowing down. So we can see this is their major pivot. This is their, their encore of what they want to do into the future, and they are proving to be successful at it. Considering in 2021, the amount of acquisitions in their pipeline have gone up like 60 or 70%. So they are showing some real robustness on the underlying value of this business. The dividends themselves, I wish they would increase a little faster. This company has been increasing them year over year. It is a little sloppy for some reason, and I don't know why, because I didn't know REITs can go below like 0.01 cent. I didn't think there was less money than literally 1 cent, but apparently they'd go to the fourth decimal place, at which it's gone from 0.08 here we can see to literally like a tenth of a cent. So I don't really understand why that's been bouncing around, but either way, guys, really stable. But again, a hefty premium. I would not be buying it currently at these levels. If we get a pullback, I'd put it on your watch list, leading us into numero dos, one that I would be more inclined to buy right now, and that is Medical Properties Trust. This is a hospital REIT, and they're currently paying a 5.19% yield. And I'm going to show you that the security in this is going to be better than the next Stag and the REIT we are about to look at, with a PE of 23 and that $12.8 billion valuation. Going into those assets sitting at 19 billion, minusing the current liabilities of 10 billion, means they're just at about maybe 8 or 9 billion in underlying assets. So you're still paying a little bit more of a premium there, but hopefully over time they can grow into that valuation. So we're paying a little bit more than I'd like, but there is a lot of growth behind this company, considering they're the second largest medical property trust, publicly traded trust in the world. But they have a well-diversified portfolio, with more than 50% of it, 59% of it being encored in the US. Now, I've done a lot with REITs that are globally diversified, and you'll find out the reason that REITs try and stay more than 50% of their assets within the country they operate is because of tax deficiencies. If you were, say, buying a Canadian REIT from the US or vice versa, you get hit with withholding tax. And any of these REITs that are, or any of their properties that are exposed outside of the US, they will experience the same kind of taxes, bringing that money back over the border. So to protect shareholders, they'll always ensure that over 50% of the assets sit within the US. But my goodness, guys, 442 properties, 52 operators, 45,000 beds, 34 US states, and 9 countries. So in a pandemic world, I'm kind of shocked that this REIT hasn't been blowing up any more than it has, because you think with the use of hospitals and the fact that we're so backlogged on surgeries and everything of the such, that there would be more interest in this kind of investment class. And the best part about this, guys, unlike the 2 REITs that we mentioned, so this one in their lease structure, because obviously when you make leases with these clients, these people that are renting these properties, some of these leases can be a year, 2 years, 5 years, 10 years. But in the hospital sector, guys, these go out past 20 2030. So these clients are going to be paying these bills in a contracted lease for the next decade. But again, once we get into 2030, 86% of the leases will be coming due at hopes they're primarily going to be renewed because, again, hospitals. I don't think the hospital system is just going to go belly up here. But that's not even the best part, right? Unlike the other two REITs we're looking at, this one specifically has an inflation protected lease. Basically what this means is they are allowed by contract to increase the rents by roughly 2%, or they're saying that a 9% contained fixed escalator averaging 2.3% annually. And this escalator basically just including inflation. So this almost guarantees that their dividend will go up on the contracted leases, which I'm going to get to this news because they did drop some really fascinating news. But let's talk about the dividend first here, because this company has done an incredible job for at least the last, several years plus, increasing the dividend year over year. And that can really just come into the refinement of that escalator, because again, you can't just raise the rents on a hospital, but you can include the fact that, they're going to be here a long time, inflation's coming around, and they're just smart about this contracting, right? And they, again, have been scaling pretty rapidly here, and I can only presume this is because of the interest moving into the medical property space. But Macquarie to buy 50% stake in medical property trust portfolio. So they are buying a 50% stake in a $1.78 billion value deal, and is expected to generate $1.3 billion in proceeds for medical property trust. So this is pretty great. They're claiming that hospitals are a pivotal part of the infrastructure of any community, just like water systems, said Aldog. We hope it's the beginning of a relationship and that we can do more transactions with Macquarie like this. So like you said, hospitals in a pandemic, guys, extremely fruitful, and this company is proving that. And like I said, you're not getting exactly a huge discount here, but this company has been flatlining and hasn't even recovered fully since its crash in the pandemic, leading me to think that there's still some room for some future or near-term upside, while also offering you a really, really healthy starting dividend yield. But keep in mind, I'm a Canadian buying this, so because I'm buying a 50% exposed US REIT, I'm stuck paying over the border withholding tax. But where I avoid a lot of this is through one of my favorite REITs, in fact, the largest holding in my portfolio, and this is primarily coming from the Canadian side of the border. But we got to talk about the RioCan Real Estate Investment Trust that also has not recovered since the pandemic, and by far sits at the best valuation, worth $7 billion, a starting yield of 4.3%. And as we do, guys, just scrolling down, their total investment portfolio sits at just under $14 billion, with their total debt sitting at about $6.7 billion. So that's giving them a roughly $6 to $7 billion underlying asset value, which is almost dead on. So you're buying this company literally for its underlying asset value, in my opinion. But if we just take a deeper look here, guys, and scroll to the top, I was a little concerned because this is primarily a mall REIT. That's what it's most famously known for, but it is pivoting, which we'll get into in a second. But we can see that the revenue here from 2020, when the worst of the worst hit, that they've actually been able to increase their total revenue, which is pretty impressive to me, along with the decrease in their funds from operation. So this is kind of where things get convoluted, because the funds from operation are directly correlated to rent. REITs are kind of hard to understand for this reason, because RioCan has been selling some properties, some interest in some of their properties to offer a bit more cash flow, a bit more liquidity. So we can see when we look at the funds from operation, there has been a decrease for the 6-month end over this time last year. However, when you look at the total revenue, it has actually been up. But keep in mind that there was a slight decline and a shift in tenant bases, which we can see on their last presentation here, where we can see that the enclosed kind of property mix, and this would have been things related to like the movie theaters, the clothing brands, things like that in the mall sector for them, that they've actually decreased them pretty drastically over the last year since the pandemic kind of ruined it. And we can see that sits in apparel. They've lowered it by 40 basis points to 6.6%. But the vast majority of this portfolio is encored by consumer stapled companies like groceries, pharmacies and liquor stores, valued retailer, essential personal service. And when you look at this doesn't scream excitement. I mean, this doesn't scream e-commerce. This doesn't scream like hospitals. So, I mean, you probably might be a little bit more concerned. But when we take a look, guys, what it fascinates me the most is because this is in my backyard of Toronto. And in Toronto, guys, I've taken it. Actually, I was just in Toronto yesterday looking at these properties to see how the developments were going, just in passing, not like it was my intended purpose for going down there. But the value creation through mixed use development, as they try and focus more on condo and office buildings, and they have a 40.6 million square foot pipeline coming online. And some of the tenants to fill this pipeline is incredible because a lot of the buildings are already 90% sold for rent. They already have people willing to move into these, fill them up, and they've also got tenants coming in such as the likes as Shopify, which is going to be moving their headquarters into a RioCan property. But we can see, guys, this is probably going to be the most juicy thing because the completed in development by 2023 is basically going to consist of 4,178 residential units and 6,345 condo townhouses. Scrolling down, we can take a look at this. This has been something they have been working on, I think, for the last several years as they've been pivoting their properties out of the US, trying to focus on Toronto, which, for those of you that aren't aware, Toronto is the fastest growing city in the world by property valuation. And the fact that we have so many immigrants, we've got another 1.8 million immigrants coming in the next couple years by 2023. There's just a lot that I'm bullish on because I understand the Canadian economy so well. And honestly, there are some downsides to this, guys. And one of the downsides comes from the dividends because this company, out of fear, even though they could afford to pay the dividend, it was getting tight. So they cut it by 30%. We can see that they did that at the beginning of 2021. So basically, as management decided, hey, we have enough cash, let's not cut the dividend on people that may be relying on this through the pandemic. They waited till 2021 and then they pulled it back. I would not be surprised if at some point as the residential units come online that they reinstate the full dividend. But unlike the other two REITs that we looked at, clearly this one has been hindered the most and obviously shows that, in my opinion, the worst management performance because this is a REIT that hasn't experienced any real growth since realistically 2007 from the equity side of it, or realistically from the dividend side of it. But I'm putting a bit of faith in this company. I think for the valuation I'm paying, if management can turn this around and really bring these really high premium properties into fruition, that it could be relatively fruitful from the stock side of it while I collect some cash flow for today that doesn't have tax implications on it. Now, this company as well is trying to market toward a new audience. I'm finding that every major REIT right now that isn't making this pivotal shift into residential might be hindered because, again, everyone's moving into online shopping. And we can see that their new condo on the Queensway reaches out with a unique social media studio. So they are trying to claim, interest to people like myself that need studio space. I'm operating out of a tiny room. This is something I would definitely be looking for when I move out here in the next year, to be looking for something that can offer me a little more space. And we can see the hottest upcoming YouTuber TikTok sensation may emerge not from someone's bedroom or basement, but rather from an innovative amenity space at the Verge condo coming to the Queensway. Now, the Verge is one of their most major properties in Toronto. I honestly think these properties could be worth billions of dollars because they're just in the most premium spots in the city. Like I said, this is one of my primary reasons that I like it. I just want to own the best real estate in my city, and this is the only REIT that I believe truly offers that. So, encompassing that for RioCan, guys, I'd say that RioCan probably from a valuation metric stands at the best point right now for buying a REIT today. And obviously I could say this about a lot of other REITs. This is just one that I like. I'd say that medical properties trades for a fair valuation. However, this one against these other two, I think for a middle kind of entry point for the highest yield, because RioCan even right now isn't offering a 5% yield, this will get you started in the highest yield in a sector that is stable with leases extending for the next decade, knowing that dividend is going to increase. Again, not like crazy increase, but enough that it will go up year over year. And it's just incredible, guys. I just love this one so much. And then, of course, Stag. This is one I put on your list if it drops. If we can get back to a 4% yield where I was collecting it, I would really consider buying into this one. So this is how I've kind of attained a property global diversified portfolio of real estate investment trust. All three of these drastically different sectors of the market, all three of these offering me a crazy cool amount of global diversification. And at this point, I want to pass the question off to you. What do you guys think about these REITs, and what kind of REITs are you interested in? Because maybe I'll find another one that I would love to add. And I have been looking at lots. I've been looking at storage REITs. I've been looking at the cloud computing REITs. There's just a lot going on out there, guys, and it's been a pretty incredible year. So stay cool, stay awesome, and I look forward to catching you tomorrow.